But let's take the point forward on equity markets. We have with us Abhishek Bhandari, the senior equity analyst at Nomura India, joining in on the show right now. Abhishek, hi, good morning. Good to have you on the show. We were just chatting with Lawrence Belanco from CLSA. He, of course, reads charts more carefully than, fundamentals. But he said that we could very well hit 1 lakh on the Sensex in the next 5 years. Forget 5 years, but in the very near term, I wanted to understand what is your overall market expectation, considering that, we're just on the brink of another earnings season where we're going to see input cost pressures really take a toll on the consumption basket.
Good morning. Good to be on your show. So while I can't, speak on the broader market, I can speak on my area of expertise, which is the Indian IT services. The result season starts early next week, and I think we will see a continued demand momentum on the Indian IT services pack. More so, the mid caps, we expect them to grow, faster than the larger cap names, and that's broadly a reflection of the overall demand strength we are seeing globally in terms of IT services. Companies are trying to spend more amount of money to catch up their underinvestment in technology, and cloud adoption, has increased dramatically after COVID. So we remain positive on the demand outlook for the Indian IT services company.
If Accenture numbers are anything to go by, can I say that the same is expected from large cap IT companies? Because Accenture is using the word demand, not pressure. Accenture is using the word opportunity, not wage pressure.
Sure. Hi, Nikunj. So look, it's not really fair to say what Accenture has done could be expected from the Indian IT companies. In context, Accenture has actually increased the guidance by almost 1,200 basis points on almost a $50 billion revenue base in last 2 quarters. That's unprecedented. Having said that, I do expect, the Indian IT companies to grow in double digit going into FY23. So clearly from a demand side, we don't really see, too much of downside pressure. I think the only risk right now to my mind is the European outlook, given that the geopolitical risk in Europe is leading to a material cut in the GDP estimates by the economists out there. And among the large caps, TCS to that extent has 32% or the highest exposure, and Infi has lowest at 25%. On your second part around pressures or the word demand, I think while demand side doesn't look to be at all under pressure, I think the real thing what companies have to work around is on the salary side. Given that for the first time in multiple years, we are looking at extremely high inflation numbers in developed markets. So should the companies have to compensate their employees in those locations in line with those inflation, it could be a material headwind for most of the Indian IT companies which they'll have to work around with.
Okay. Now let's compare valuation versus opportunity. Most of the large cap IT companies, based on 1 year forward, according to your numbers, are trading at 20 times plus. Can that be justified? Because base effect would kick in, wage inflation would kick in. What about investors? The sector may go, it may give no returns. Is that possible?
So look, fundamentally speaking, we are calling out for for the demand to remain in strong double digit at least for next 2 years. And in context, that's almost 1.5 times of pre-COVID level. Pre-COVID, the sector used to grow at 7 to 8%. We expect the sector to grow at least 12 to 13% over next few years. That's the starting point. I think the margin pressure is going to be transitory. The reason being, while this inflation-linked pressures in developed markets are going to kick in and hurt the margins in the first half of fiscal 23, do keep in mind, after multiple years, we are hearing companies talking about good amount of price increases in their contracts because globally the talent, at least on the tech side, is in significant shortage, and the clients are willing to compensate the service providers for a higher inflation. So I think maybe after a few quarters, once the inflation also starts subsiding and the real effect of pricing kicks into the contracts of these companies, we'll see a margin improvement. In context, if you sum up these two, we're looking at the sector likely to post a healthy teen kind of earnings growth, at least for next 2 to 3 years. And in that context, multiples are probably not very expensive. We like, large caps more than the mid caps, given the difference in valuations. Large caps are probably trading at much more reasonable valuation, which in the range of 20 to 25 times, depending on the company you look at. versus mid caps, which are trading upwards of 25 times. So no, I think the historically we have been used to looking at the sector at lower multiples, but those were the days when the earning growths were much lower, the revenue growth was much lower. We're looking at a sector which is likely to grow much faster in coming years, and in that context, I don't really think valuations are very expensive.
Abhishek, this is Nantana joining in. What we're also going to get this earnings season is all of the companies giving their full year guidance, right? And while you prefer the large caps, there is something that we always see, which is that Infosys turns out to be conservative when it gives its full year guidance. Is that something that could disappoint the markets?
So look, in a recent quarterly preview, we did note that we expect Infosys to give a guidance of 12 to 14%. And in context, that may not be a very bad outlook to begin with. Just to remind you, last year, when they started FY22, they started with 12 to 14, despite having a very large number of mega deals in the kitty. And this year, we have not really seen them have multiple mega deals. It's more about short cycle deals, what they're winning. And in that context, 12 to 14% might be a decent start. You are right. Infosys traditionally has been conservative. They start slow and then keep upgrading during the year. But I think 12 to 14% should keep the investors happy.
And there's a lot of chatter as well that the real surprise in the fourth quarter could come from Tech Mahindra, and that it might, out of all the IT counters, be the leader when it comes to revenue growth.
True. So we expect 5% kind of sequential growth in Tech Mahindra, which on reported basis probably would look the strongest. But if you were to strip out the inorganic contribution, they're likely to grow around 2.5%, which I think is broadly in line with most of the other large cap names. So, the growth optically will look stronger because of the inorganic component. In Tech Mahindra, however, we think in near term, they could have a significant margin pressure, given that, they still need to step up their hiring engine. They're running at very high utilization levels, and they have been, hiring more number of people in last few quarters, which continues to weigh on their margins.
Abhishek, good to have you on the show. Thank you so much for taking the time out.
Thank you.